Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Chad here, your hosts for this weekend show. On this weekend show, we are going to be starting off with more a roundabout look at the financial markets, looking at what's going on in the U.S. broad averages. Also talk about money that seems to continue to move into international markets and touch on some of the commodities. Back end of the show, we're going to focus even more on the energy sector because those sectors have been under a lot of pressure, especially crude, trying to figure out where a bottom is. Just as a note, please, everyone, go back through our website, podcast, YouTube channel, and Substack account for all our daily editorials and company updates throughout the week to stay more on top of daily market moves as well as key company updates. Without further ado, let's get into this show, starting off with Dana Lyons, fund manager and editor of the Lyons Share Pro website. Dana, let's start with broad market recap here. We have seen the markets rebound after an absolute washout near the beginning of April, after Liberation Day. The markets have managed to get a little bit of footing. The S&P from its low has rebounded about 16%, still a little ways away from all-time highs. And I know still a lot of negativity or at least trepidation within a lot of the investors and commentators we talk to on a daily basis about the stability of these markets. Dana, your outlook. What do you think about this rebound that we have seen in the broad averages in the U.S.?
Yeah, thanks, Corey. Well, I think as we've discussed in the last show and in prior shows, I think this rebound is more of a reflexive kind of a B wave higher off of that initial correction low, that washout that we saw in early April. Again, corrections tend to follow a similar pattern, or what we call a roadmap. You get the initial sell-off into that panic low like we saw in early April. You get that reflexive bounce up into some manner of resistance. Prices get tired. Those people have had to cover shorts, fueled that reflexive rebound higher. They've covered their shorts, and then you have a number of people that still want to sell this thing that didn't sell it the first time, and so selling pressure comes in again, and you get what they call the retest of those correction lows. So I think we're very close to that point now, that top of that V wave, and we should see that C wave lower commence pretty soon. I think whether it's, now or a few days or whatever it is, I think the risk reward ratio or relationship is substantially skewed to the downside right now. So we've been selling pretty aggressively over the last few days, getting set for or defending ourselves against, like I said, what should be potential retest or maybe new lows, maybe not new lows, depends on the average, but should see some sort of a C wave lower coming up soon.
Well, Dana, just in thinking about the C wave lower, you were making a point to us off mic that, when you have this ABC pattern, A down, B up, C down, and then you start finding your footing at that bottom, there's certain sectors that are holding up better and showing more relative strength compared to other sectors, and you would anticipate those sectors to be the ones you want to be positioned in for the eventual, upcycle and the series of waves up. So when you look across the different market sectors, which ones stand out to you as ones that are holding up better, and that even though we may still see some downside pressure, would be the ones you'd want to start accumulating at that C bottom?
Yeah, absolutely. That's a good call. Now's when you start getting clues. Well, there's two junctures. Okay, in this B wave higher, those markets that are able to blast through perceived resistance and approach the prior highs are those areas that are set up for potential future relative strength. So those are on your radar. And then again, in that C wave lower, the retest, you want to see which areas hold up the best, hold up above the prior lows by the biggest margin, holding areas of support, holding near those former highs. That's what you want to see. in terms of trying to glean what's going to be intermediate term relative strength going forward. And what we see now is a lot of the international markets have actually rallied back or to the former all-time highs or the prior peaks that we saw earlier in the year, especially in Europe. So you've seen broad averages internationally. Have you seen averages in Europe, even Canada approaching those former highs? So I would say those markets have retraced the most of the correction losses that they saw. So that's a good sign, a good heads up about potential leadership going forward. We're also seeing among some of the U.S. sectors, some of the defensive names or value names, like utilities hanging up near the former highs, aerospace defense sitting up near their former highs. Some of the areas within financials have held up relatively well. So those are some of the names that have recovered the best or held up the best. Right now, we want to see them maintain that kind of solid, constructive technical position on any sell off, any retest coming up. And those would be good clues that those are some areas that you want to be in going forward.
This shift of money really seems to be a theme I'm hearing a lot of over the last couple months now into more value out of growth and even more international out of the US. And these sort of shifts, they happen from time to time. I understand that. We've seen this plenty of times, but there's just so many comments that I've been hearing that this could be a longer term shift, that maybe the way other countries are viewing the US is that they're not going to be giving the US equity markets that multiple that they have in the past. I know making these long-term proclamations can be very difficult, but Dana, what sort of things do you look for on the charts in your models that can indicate when we are seeing a longer-term secular shift in where money is flowing, especially when it is out of growth, which had been such a leader for so long?
Yeah, for sure. And you get fits and starts, there's always money rotating. So whether it's a short term, medium term, or longer term shift, it's hard to know at the time. But just one easy type of clue is just look for those big seismic events on the charts, the big blow off tops, the big washout bottoms. Yeah, I think about, similar to recent price patterns. You look at the dot-com bubble back in 2000, which was an obvious just blow off and signals a shift out of those types of stocks and into value or other types of stocks. We saw that, I think, really over the past 6, 8 months here in the U.S., looking at the semiconductor stocks, the Mag 7 stocks, just another, not to that extent, but say similar type of a blow off move, and then kind of popping of the bubble. And those seismic type events are a good clue that, okay, maybe there is a longer term shift underway, because to get those types of bubbles, you have to have massive amounts of money flowing in and then massive amounts of money flowing out. And that's going to go somewhere. And in this case, I think, again, we have to continue to monitor this, but it looks to us like a long-awaited kind of longer-term shift to value from growth and potentially to international from the U.S. The types of shift are certainly underway or potentially underway. Again, the international shift we've been waiting for, not waiting, other folks have been waiting for it for really well over a decade now, and it just hasn't happened. Seeing certainly signs of that, like I mentioned, the international stocks really outperforming this year, and especially in this recovery, they're back up near their former highs. So maybe that's a longer term shift towards international. I don't know yet, but certainly in the intermediate term, that would be a good place to start in terms of looking for that international leadership.
Well, Danny, when you think about the lay of the land, and if we do have in the near future another leg down and a corrective leg, a lot of people have been trained for the last let's just call it 15, 16 years, to always buy every dip in the general markets, thinking that markets can only go up, not realizing that there's two directions they can go. And so they've been buying the dip and they've been piling into tech in particular as the tech leadership, like you were alluding to, the Mag 7, but even into the AI and the semiconductor stocks recently. What happens when leadership actually changes? I know that money rotates and people change, but there's going to be people that keep going back to the well. And how would you advise people that you talk to in your audience about not getting stuck into the same trap of assuming that the markets have to be like they were in the past moving forward?
Absolutely. And that's part of human nature and investment psychology that's so difficult to overcome is that you get stuck thinking, okay, this market going forward is going to be like the market that we recently knew, the recency bias. And when you get these seismic shifts, that's when investors are going to lose the most money. Again, going back to the dot-com bubble, because that's the most egregious example. I recall, after the bubble popped in the spring of 2000 and stocks really started really crashing from their bubble highs. I recall, you know, and not just anecdotally, but massive amounts of people quitting their jobs just to get into day trading because they saw the opportunity and buying these dips in the dot-com stocks that had for the prior few years had certainly every dip had paid off, and the wealthier that not they, but probably their friends or someone they knew or some family member, the wealthier they got, the more FOMO, I think people got, and so they were waiting for the next opportunity to participate themselves, and it turned into years of, oh, you better be selling the rips instead of buying the dips in these things because they're just massively over owned and had a couple of years of distribution to get through before they even bought them. So that's the danger in terms of these longer term market shifts is that people get stuck thinking they're in the same type of market. And to add insult to injury, it's not just that they're sitting there with the same positions that are going down and getting hurt, but they're buying, like you said, they're buying on the way down constantly and adding to their losses, and those things keep going down once the top is in. So that's the real danger, and that's the devastation that happens to investors that get stuck thinking you're in the same market.
Okay, we talk so much about this shift that could be happening, and I see many reasons for that shift to happen. But Dana, if we could step back a little bit from just your models, and I know you don't usually do this, nor do you like doing this, but let's face it, the sentiment around the US is as negative as I have ever seen it in my life. Countries, individuals are viewing the US very negatively. People aren't traveling to the US as much. Economic outlooks around the world, but especially in the US, have become quite negative. Earnings calls out of the US, some companies aren't even providing guidance because they don't know what sort of landscape they're going to face in the coming months, let alone in the coming weeks. How do we take this all and take a step back and understand that markets do change, but there's so much news right now, and the sentiment has swung so negatively towards the US, something that we haven't seen in decades. I don't know the last time we've seen this. How do we have to consider again the barrage of negativity we're getting about the US markets and filter that into some of our decision making when it comes to investing?
Yeah, good question. A couple things. First, you're right. I don't like to go outside of our models because they're quantitative and objective and smarter than I would be trying to parse out this, you know, news headlines and whatnot. And they got us out of or defensive in the market back in mid-December when everything, looking at the charts, listen to sentiment, everything was seemingly rosy, and yet there's breakdowns going under the surface. So that's why we listen to our models. But your point is well taken regarding sentiment. I think you got to use sentiment to your advantage. And the way we do that is typically just by fading it, but it has to be at extremes. It's hard to say, okay, sentiment is kind of bullish or kind of bearish, and try to glean a signal out of that, because sentiment usually isn't very helpful unless it's at an extreme. And as far as country-based sentiment or news-based sentiment, it's hard for me unless I see an actual measurable or data. It's hard for me to make a judgment on that. But as you mentioned, the anti-U.S. sentiment, in my view, I think it's a product of the media, maybe right now, and the political statement. I do seem to recall about 20 years ago being in the same type of the U.S.'s toast type of sentiment, or maybe during the financial crisis. To me, I would tend to fade that. Even if I can't find a signal there, I would tend to fade those types of concerns. But at the end of the day, if I'm going to use sentiment, it's going to be at an extreme, like we saw in the washout in early April. I'm going to see measurable sentiment that reached historic levels of fear, and I'm going to jump in and fade that and start buying. But that at the end of the day, when it comes to investment decisions outside of sentiment, we're going to stick to the models and let that kind of be our guide, and leave the headline reading, headline investing to other investors.
Fair enough, Dana. And another market we could say got to an extreme level for multiple reasons, but it was the gold market and that uncertainty in the sell the US, or, just not sure where to go to rotate money. A lot of people went to the safe haven of gold. That's kind of its role as like an insurance policy in people's portfolio. Now, there's been a lot of central bank buying. There's a lot of reasons. I know you scrub all that and put it aside and look at the models. We've seen a pullback in gold now over the last couple of weeks. What do your models say about the gold price? And then maybe bring into that also the gold equities.
Yeah, well, in terms of our investment selection, we're relative strength traders or investors, and we're going to follow the trend. And gold certainly is still, among the better relative strength leaders. So we're going to stick with that for now, despite a little bit of a hiccup over the last couple of weeks. That's not enough to register on our models, to be honest. So we'll stick with our trend, and stick with our positions in gold. I would say, when you talk about sentiment, one area maybe it is getting overheated, because it's hard to find anything negative about gold after, many, many years of that's all you would hear. But we've had such a substantial move that certainly I wouldn't be chasing it higher. I'd wait for some sort of a decent pullback. And if the trend ends up getting broken to the downside, then I pull the plug. But I would say, as an ETF trader, we hold positions in GLD as well as the gold miners. I would say if we get a shot around 286 on GLD, we would certainly step in and aggressively buy some more back there. But at the same time, on the upside, if we get up towards three and a quarter, 325 or so, we'll probably trim a little bit. So I got to stay objective. Nothing as great as the narratives seem. Nothing is a buy and hold. Nothing is a short and hold. You got to keep reminding yourselves that. And especially when it comes to commodities, which are, price constrained more than potentially equity, and as a single equity, which certainly can move more indefinitely than maybe a commodity. But a long story short, we'll stick with the GLD on gold as long as the trend is higher, and now look for areas on pullbacks to add to that position.
Okay, that 286 level only about 3.5% down from here, so not that much further after gold has corrected. Let's just round it off to about 7%. Well, what about GDX then, the gold miners ETF? That was outperforming gold to the upside, and it is marginally outperforming to the downside. That's down about 11% from its recent highs. What are the levels you're looking for in GDX?
Yeah, we saw, for, I guess, going back over a decade, the highs in GDX around that 45, 46 level. So that's where the breakout occurred. We had a little bit of a follow through after that, but I don't like chasing breakouts anymore. If we get a chance, though, down to buy GDX down around 46 or a little bit below, we would certainly jump on that. That would look like a phenomenal place to add to that position. And as far as GDXJ, the junior gold miners, We ran right up into those highs from 2020, the COVID highs, up around 66, 65, 66, and pulled right back from there. So again, you don't want to be chasing these things into moves that are up on a rope. Wait for a pullback in GDXJ around that breakout point in the 57 range. I'd love to get a shot at buying some more of that there.
Well, Dane, another commodity that a lot of folks listen to the show follow is oil. You had a really good call. I'll give you a hat tip to short oil, and boy, that's paid off because oil has crashed below 60 now. It's in the mid 58s at the time of this recording. What do you make of where oil is priced now? Is there further downside in your opinion, or are you keeping your shorts in place?
Yeah, we did appreciate that. We did have a short on crude before the breakdown looked vulnerable to us. It did break down below that. I guess it was about a 3-year range and had some nice follow through. Covered a little bit. It rallied back up to that breakdown point the other day and failed immediately, which if you're short, that's exactly what you want to see at this point. I think there's about 10% more downside. If we do get that extra 10%, I'd be looking to cover all or almost all of the rest of the shorts there. That's all I was looking for. That was about maybe 20 to 25% short on the downside after that break of support.
Is there more damage to be done here because it has broken to what 4-year lows? Is this a change in tenor for this market that had been pretty strong?
Yeah, I don't know. This was purely a technical trade for us, so I don't know what about the underlying factors of, really impacting the price of oil, all the geopolitical factors. I'm not about to weigh in on that, but this was just merely a technical trade. So again, about 10% below current prices is about what we were looking for as a target. So we'd be happy with that. We'd be happy covering our short at that point.
What are your thoughts, just in a general sense, on when a asset class is in a trading range like oil has been, and then it finally breaks out of it, either to the upside or the downside, and establishes a new range? Is that where it gets stuck for a long period of time? And we could bring the U.S. dollar into the equation here because it's also been in a range testing the lower side of it. But what is there any knowledge or insights you have after looking into markets, how they behave when they finally break out of that long range? Does it just set up another range, or can it set up a cascade move?
Yeah, it really depends really on the pattern, how long it's been in that pattern, what type of a pattern that it's been in while it's been range bound. If it's been basically bottom to the top of the range several times and then you break out, then usually that leads to maybe another setting up a new range to the upside, or in this case the downside. Whereas if you're looking at a breakdown, it's been a long series of proximate lows and then lower highs, like a descending triangle, and you do break that lower bound, then you're looking at the potential for more of a cascade, more of an extreme sell-off, more downside potential there. But I would say, obviously the longer you've been in a trading range, the more times certainly that's been tested. Once you do break, obviously that's a powerful move, considering that if you look at the price of crude for the last 4 years or so, we were not able to break that level. Once you are able to break that level, that's a powerful signal that, okay, maybe you've cleared out a lot of that support, that buying power, and does open up serious potential to the downside, which is what made that short to us so attractive.
So, Dana, as a technical trader, as one who focuses on your models and one who is willing to make trades quite regularly, you must be loving this volatility because a lot of these markets, they are moving multiple percentage points a day and not just in the same direction. It is choppy, and the overall long-term trends, a lot of those are really in question. So, can you give us a time in history when we have seen this sort of volatility and how it impacts your trading strategies and, even more importantly, your time in certain positions?
Yeah, volatility to us creates opportunity. And you look at just the correction, especially the downside. Volatility creates opportunity, especially when you're discussing a correction, which follows the same type of a roadmap like we talked about before, a very consistent roadmap. So that provides opportunity for us. But at the end of the day, whatever data matters, we've put together models that tries to incorporate a lot of internals, a lot of breadth, a lot of money flow type of indicators. And at the end of the day, anything that is useful or anything that is meaningful in the markets, as far as the price movement of the markets, we've tried to incorporate into our model. So if there is, whatever's causing the volatility, it should feed into the models. And if it's just volatility and our models hold up, then we can ignore it. If, like I mentioned back in December, on the other hand, we saw a very calm markets up, averages up near the all-time highs, and yet below the surface, we're seeing a deterioration. So that's why we like to stick to the models. They can see things below the surface that maybe we're not seeing with our eyes in terms of price movement. And at the same time, it can filter out a lot of the noise that, okay, maybe gets headlines, maybe instills a lot of fear or greed. But at the end of the day, maybe it doesn't, maybe it's not that meaningful for the longer term trend. So we like to stick to that intermediate to longer term trend and really focus on the data that matters. That's why focusing on data as opposed to, kind of trying to subjectively come up with a narrative or investment thesis is to direct your investment is really, I think the number one most important thing that an investor can come up with, and because we talked a lot about sentiment and human nature earlier, we fight the same thing. Professionals fight the same thing. We're subjected to human nature as well. And the more you have something that you can hold on to that's consistent and unbiased, that makes all the difference in the world, I think.
Yeah, Dan, it's great having you on this show. And you are so right. We talk to a lot of people on this show, and there's a lot of people out there that, quite frankly, have a narrative in their head and then construct that narrative into their trading strategies and how they read different data points and how they read the charts. You're always a breath of fresh air, just telling us what your models are telling you. And again, not biased towards any certain sector, which is why you can trade all these markets and have these targets up and down for a lot of different sectors. I take what you have to say with a lot of credence, and I pay a lot of attention to when we have you on the show and hearing, especially when certain positions change for you. So, Dana, really appreciate all the time you spent with us, especially on this weekend show, making sense of all this volatility and choppy trading action. If you want to keep following along with Dana, visit the Lyons Share Pro website. I will include that in the show notes on our website, YouTube page, and through Substack. Be sure to click that link and follow along with Dana if you want to be that active trader and stay on top of changes that his models are showing him. So, Dana, great chatting with you. Thank you again for your time on this weekend show.
Appreciate it. Thanks, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and we are now switching our focus exclusively to the energy sector, mostly oil and natural gas, as we are chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report. That's where Josef dives into individual companies, sets out what he thinks investors should be doing in terms of where some of the best opportunities in the stocks are, more on the investment landscape. He also writes the Eye on Energy Report, which is a free report that covers the macro, the fundamentals within the oil and natural gas sectors. So as we always do, we'll start off with the pricing environment of oil and natural gas and get into some of the questions we've received on the stocks underlying those commodities. So Joseph, great having you back on the show. Let's talk energy because energy prices broadly lower. Oil, as we are recording this Wednesday, halfway through the day on Wednesday, crude's having a rough day. It is down to about $58 a barrel. Look, these numbers in the 50s, even though it's high 50s, these are prices that we haven't seen since early 2021. And it has broken a trading range that oil has been in really ever since 2023, a multi-year trading range. I realize there's a lot of push and pull factors here, but Joseph, we do need to address the fact that with this breakdown, is the sector in some sort of threat here of simply continuing this downtrend?
Well, let's go through, the fundamentals first. The market's concerned that OPEC is going to raise production by 431,000 BOEs a day or barrels a day in May. And that comes during a soft period with, of course, recession, concerns in the States, Canada, China, Europe is there. And so too much volume is driving part of the reason you're seeing lower commodity prices. The other thing is you're seeing the issue of, Iran, Venezuela on the positive side, where if Iran doesn't sign a deal on the nuclear side, they could have sanctions that would remove in Q4 1.5 million. Venezuela has until May 27th before U.S. sanctions kick in. They were producing over 900,000 BOEs a day. Then when sanctions kick in Q3, they'll lose half of their volumes. So I'm in the bull camp that by fourth quarter, we're going to be $80 oil. My concern in the near term has been that we're in the shoulder season. Inventories build now. You had the OPEC announcement, and fear has taken over. Are we going to have an oversupply in the month of April and May, especially if the 431 comes on? Yes. Get into July and the summer driving season, and everything tightens up, and demand is greater than supply. And then once those sanctions kick in on Venezuela and Iran, then all of a sudden the game goes in favor of the bulls. So today we're at $58, as you mentioned. When the price got up to 64, 65, I said that we're going to back off. In April, we got down to $55 on a spike downward. We recovered afterwards. I think we're going to test the lows. I don't think we go much below them if we go below them. But I think the decline is going to be coincidental with weaker general stock markets, which is what you're seeing today. And I think the Dow, which is about 40,000, could go down to 35,000. The NASDAQ, which is around 19,000, could go down to 13,000. So there's quite a bit of downside. Or NASDAQ, sorry, 17,184. I think it's going to 13,000. I'm just looking at the numbers fresh in front of me. And so I think that there's downside during the month of May. If the trade deals don't go well, everybody's optimistic that there's going to be good trade deals. Everything takes time. You may have an outline of a deal, but until you do the paperwork and get everything implemented, I think people will realize it's not going to be good. The Port of California is saying that the number of ships coming over to unload is about 30% below normal. We're already hearing from stores that in June, you'll be paying more for the goods that are coming in now that are going to have the tariffs on them. There's been some acquiescence by Trump on the autos if the cars are finished in the U.S., but that's still going to mean higher prices because the tariffs are there, but then you get a credit if you finish the cars in the States. So we don't know until June the day-to-day impact on consumers, and I think people are restraining themselves from spending now on discretionary items. Even Starbucks this morning announced weaker revenues, weaker earnings, and the stock's down 8%. So we're looking at a market here that's nervous. And if we continue, this is a big week for earnings. If those earnings are weak and the rest of the earnings for the Q1 are not favorable, which they don't seem to be, and most companies are not prepared to give forward guidance because they just don't know, that uncertainty, I think, causes a market pullback during May. I'd also point out that we've got more geopolitical tensions out there. We've got the issue of India and Pakistan now, which is new and an ugly one. Second, the Russians have defeated the Ukrainians that invaded Kursk, so they've pushed them out. So the question is, what happens now on the negotiations, and are they going to be tougher because Russia controls all of its land again? And then, of course, we have the issue with Iran. If they don't do a nuclear deal, Trump has said they would lead the attack. So I think, and then of course you've got China with Taiwan, which has been more aggressive by China. So I think there's some geopolitical event that potentially, with weaker earnings, tariff concerns, are going to drive the general stock markets lower. It's going to be a great buying opportunity when we get to those lower levels. And I've mentioned 34, 35,000 on the Dows, 13,000 on the NASDAQ, 215, 225 on the S&P TSX Energy Index, mid 50s on the price of crude. That will provide the next table pounding buy for energy securities. We had one in early April, and we sent out a table pounding buy with 4 new recommendations. I'm waiting to get the next buy window, and then we'll be sending out another buy window recommendation. And the one that's interesting, in early April, historically, when you get below 10% on the S&P Energy Bullish Percentage Index, it's a buy signal. Anytime you get below 5%, it's a table pounding buy. In March of 2020, we got down to 3.7% bullishness. So that was low, and we all know how good stocks did after that. The only time we've had a 0% reading before April was in 2008, in the end of the year, when we saw 2 readings of 0. We got a 0% reading that lasted 3 days in early April, and we used that as a buying window. I think we're going to come back down below 10%, maybe even below 5% in the next few weeks, and we're going to use that as a buy window. Stocks are exceedingly cheap. We've got a lot of overhang of concern, the politics in Canada, low oil prices. But the solution for low oil prices is low oil prices and removing production. And if we remove Iran and we remove Venezuela, the bullish story comes together very quickly.
Well, Joseph, I was going to ask you about that low that was hit in April down at 55. So you think oil prices could pull back there, but in a backdrop where on the macro side, as you outlined, there's a lot of uncertainty. A lot of businesses saw a pull forward in sales from some of the reports I've been seeing, but they think that was people trying to get in front of the tariffs. What happens to the oil equities if the general stock markets are pulling back and we see a contraction in the economy because maybe people aren't using that discretionary spending, maybe people aren't going out and even driving as much this summer? We see travel and tourism down quite a bit, double digits. What could happen to the oil stocks when they're stuck in this tug of war between equities pulling back, a lower oil price, and a potential of a contracting economy?
Yeah, not all groups, move at the same time. Oil's been down for a long time, part of 2024, part, this year. And it's only since February that the tech sector has gotten wrecked. So I think that, there's not as much damage left to go, mid 50s, let's say, for oil. The oil stock's down from, I think today we're sitting with the S&P TSX Energy Oil Index is trading today at 237. I think it's going to go to 215 to 225, so just under another 10% downside. So 10 to 15% lower prices to get to those bargain levels, which I think will happen. And people should be loading up because you've got a lot of companies that have, even at today's prices, they've got good hedges in place. They can handle $50 WTI and still, because of the 1.37 exchange rate for the Canadian dollar, 72 cents, they can do their capex, pay their dividends, and they have hedging in place to support that with cash flows. And I think we're going to see, those stocks get taken up and bought, and many of them are yielding 8, 9, 10%. So, compared to what you get in the bank, you're getting paid enough by these energy companies, and the upside is there, and they have a high beta to higher prices. So everybody's so gloomy. If you remember in Q1 of last year, when the price of oil was 85, everybody was saying, oh, it's going to 90 or 100. And I was seeing signs that there was slowdown in the States, slowdown in China. And I was saying, and you guys, recall this, that I was saying we're going down below 70, and we did. And so now nobody's looking at the fact of what's going to happen with Iran and Venezuela, and you automatically remove 2 million barrels, and the gig is on at higher prices.
Yeah, well, the big question being, is this a temporary drop in prices, or are we in a lower pricing environment here? That, in terms of a longer term sense, that is the big question. It's just interesting to see. I find that the larger oil stocks are holding up better, at least those ETFs, compared to the smaller ones. So what that means, and even those larger energy stocks are holding up better than the drop we've seen in the oil price. And Joseph, we're going to get to dividends. We've had many questions on how stable these dividends are, but just a quick question on capital spends. You really went around the world there talking about supply. What are you hearing from companies in Canada and in the US in terms of if they're winding back some of their capital spends right now?
Well, first thing, technology has improved so much with longer reach wells, doing multiple wells from pads. And, so you're getting companies focusing on keeping production flat, using the, free funds flow for dividends, NCIBs, normal course issuer bids, buying back their stock. And companies are continuing to do that, with the Canadian dollar where it is. Even though companies may not grow in 2025, they're still going to be able to do things right for shareholders. So I'm optimistic that, that we're going to see, the stocks bottom in the next month or two, and that the upside between now and year end, if I'm right that we see $80 oil by the end of the year because of this aggressive sanctions against Iran and in Venezuela, we could see many stocks on our list go up 50% or more. So it's just, to me, this is one of the most exciting times. April was exciting. 2020 was exciting. 2008 was exciting. But when everybody is fearful, that's when you should be greedy. I think that's the Warren Buffett. And when everybody's greedy, you should be fearful. And as I mentioned, Mark Bobius is now 95% cash. So in the near term, I think we're going to see some ugly markets for the next month or so. And can the market drop 5,000 points in the Dow in a month? Sure. We've seen 1,000 point days, 2,000 point days, even 3,000 point days. So up or down. And so I think this is going to be quick and dirty and ugly. Margin calls are going to be aggressive. The big thing to me, why we haven't seen the final bottom, is that the individual investors continue to buy the dips. Historically at market bottoms, the unsophisticated individual investor historically panics and barfs out their portfolios. And of course, the GameStop investors and people buying those high beta stocks, triple ETF leveraged stocks on oil and gold, and the Bitcoin world, all of those, that's where I think the decimation is going to be. And those people, because they've levered and it worked for a while, when it doesn't work, it's going to drive those investors away. And I've been cautioning for people who are using margin or leverage, get out of that, because if you want to be an investor 2 years from now or even 6 months from now, you better not be doing that, because you're going to get potentially wiped out.
Yeah, great point, Joseph. A lot of those people using the triple leveraged long funds, if we do have a pullback in the markets, they're going to be upside down in a bad way. And like you say, it takes you out of the environment where you can deploy cash into the low pricing and make volatility your friend. Well, we talked a little bit about oil and some of the oil stocks as far as how they're set up and even still secure in a lower price environment. What about bringing nat gas into the equation, Joseph? Just because in the U.S. it's still around 330, AECO prices in Canada still in the mid twos. Those are okay prices for companies. So if a company has a nice mix where they've got a balance between oil, natural gas liquids, and natural gas, is that a safer place for investors to be right now because they have the strength of the nat gas prices leveraging out the oil price weakness?
Well, if they have good hedges, I think that also makes a good difference. There are quite a few companies that did the right thing, taking advantage of the higher prices during the winter. And right now, if you want to hedge for 2026, you can hedge over $3 for the whole year, and winter hedging prices over $3.50. Well, if your input costs are $1, that's a very good business. If you're a smaller producer and you don't have liquids, you may have a break even at $2. It's okay, but it's not really good for you. So it matters which companies, and that's where you really have to do the homework on the mix of product that they're doing, the strength of the balance sheet, how much hedging they do. And I think, when you take all of that into account, and if the company is paying you a dividend, that's more than what you can get in the bank. All of those should be on your checklist when you decide which companies you want to buy. I'm going to have our quarterly webinar tomorrow night, Thursday evening at 7 o'clock for 90 minutes. So if people want to join us, I'll be covering the macro side, what's going on in the market, why I believe we're going to have this near-term weakness in May, why I believe we're going to have a bottom in May, where I think the price of oil is going to go into the 2026. And also I'll be talking about individual names of where I see the best bargains are. We cover 37 companies, so we're going to be picking the best of the best from that. And people can just go to our website and sign up to be subscribers, and they can join that webcast.
All right, Joseph, unfortunately, this will be coming out on Saturday, but I will post a link to the Schachter Energy Report so people can sign up and see the replay of that webinar. Let's talk about the underlying stocks then, because as I said, the larger stocks, you look at something like XLE, yes, it had a bad week about 4 or 5 weeks ago, as everything did in the markets. But again, it's at these levels that are low for the last 52 weeks. But overall, still, we're not at like oil. We're not at levels from 2021. We're at levels from early 2024. The smaller energy stocks, those have struggled, like the IEO. Those aren't just seeing the same money flow. So are you seeing the same panic in the large cap stocks that you're seeing in the oil price? Or it's kind of looks like from the chart, people are not exactly bailing on the sector right now.
Well, let's take the crown jewel of Canada, CNQ. It's 39.16. It's down 3.4% today. You go to Suncor, it's down 2.5% today. Baytex, a smaller name that people like, down 3.8% today. Imperial Oil down 4.2% today. And yet the TSX Energy Index is only down, well, it's down 3% today. But you've got some big down days. Vermilion is down about 5% today. Surge down 4%. Precision Drilling down 4.5%. Obsidian down 4.1%.
Today is a pretty bad day, though. Hey, Joseph, as we're recording this, oil broadly is down 3.5%.
Yeah, well, you got $2 off the price of oil. That's what's going to happen. So what you want to do is pick the names you want to own, pick a price where you think it's a bargain level, and then when you get these big dumping down days, but not yet, sometime in the next 2 to 3 weeks when the general stock market is getting whipped about, that's when you stick your bids in below the market. And I think you're going to be very happy 6 months from now if you have that sense of confidence on the companies and you nibble away on that weakness.
Well, Joseph, let's just say we get the pullback in oil to 55 and a lot of these stocks have pulled back. Not all stocks are going to respond in the same way. What stocks or what criteria, I guess I should ask, that are you looking for as far as the stocks that'll bounce back the most or have the most torque in a rebound? Is there certain factors and criteria that you're weighting heavier than others?
Yeah, I think the first thing is balance sheet. You want to have companies that have a decent balance sheet, that don't have a lot of debt, so they're not focused on paying down debt right away, and that they could be even looking at M&A activity because they have a strong balance sheet. And some of the weaker players may be willing to, the bid-ask spread on deals could tighten up. We saw the Whitecap Varen deal is getting done. So there are deals that can be done, at the right price, and those two are merging. So that's one thing. Second, for individual investors, you want some income along the way. So you want a company paying you at least a 4 or 5% dividend yield and has free cash flow to pay it. Third, you want a company that has at least stable production, but maybe 3 to 5% growth, even in these uncertain times. And then you want companies that have a lot of land, a lot of upside, that in a much higher price environment can grow their volume significantly into the end of the decade. Also, you want one more. insider ownership. You want significant insider ownership because you want them to be there not as bureaucrats and high-paid bureaucrats, but as owners who want to see the stock do well for all shareholders, including themselves.
So, Joseph, as you mentioned, the income aspect, I know that you think these dividends are stable, especially if oil gets back up into the 80s or even into the mid 70s. But here and now, because there is that split, especially in these high dividend paying stocks, these 8, 9, 10% yields, there's that balance of the regular dividends and the special dividends. Let's say oil doesn't shoot back up into the mid 70s. Maybe it stays in the 60s. Who knows? Maybe it stays in the high 50s for a longer period than you think. What can investors do to look at the dividends here and understand that they could stay hopefully around these levels? I've just had a lot of emails of people saying that they're worried that these dividends are going to be cut, or people could say, oh, the share price dropped. Look at how much it's paying now. But again, the dividends might not be coming to the same extent that they are now.
Yeah, that's where I'm going to do my homework as Q1 2025 results come out. We had Whitecap come out last week, and I see them being able to pay the dividend with the merger as well. So every company, as they report, I'll be checking to see, number one, how much debt they have, how much money they have to be spending on interest payments, how much free cash flow they have after paying for CapEx and the day-to-day operating of the business, and if they have enough free cash flow in Q1 to not only pay the dividend but have a low payout ratio on that dividend, those would be the companies I'd be focused on. So a company that has less than a 30%, in terms of the free cash flow is needed to pay the dividend, and the rest can be used to knock down debt, do NCIBs, grow the production, make acquisitions. Those are the companies I'd be looking at. If you're talking a company that's got 70, 80% of free funds flow paying the dividend, that's where I'd be, or more, then those are the ones I'd be worried about having to cut the dividend.
Just pulling on this thread a little bit longer, if a company does get into a more distressed situation where they have to make a call, cut the dividend, stop the share buybacks, pull back on growth, what do you think is the best strategy for a company to do? Should they just keep paying the dividend and cut back on growth, or should they cut back the dividend a little bit and keep some growth element there? Should they keep the share buybacks? How do you look at that decision a company may need to make, and what are you more attracted to?
Well, the first one would be is you stop growth. You just try to keep stable production. NCIB and the dividend is where the trade-off becomes. So how much free funds flow do you have? And is it a high payout ratio or a low payout ratio? If it's a low payout ratio, then you don't worry. If it's a high payout ratio, then they've got to make the decision. Do they stop the stock buybacks or do they cut the dividend? That's up to the board of directors. And again, as I mentioned, the key to me would be watching that ratio. A high ratio means the board's going to have to make a very difficult decision, and those are the ones that you got to worry about.
All right, Joseph, I want to change the topic a little bit here and talk about the difference between Canadian producers and U.S. producers. A lot focused on the Canadian producers after the recent election result where Mark Carney was elected. The Liberal government has power. It's not a majority, but look, they don't even have a formal opposition in the House right now, as the Conservative leader did not garner his seat. So they do have, in a way, kind of free reign, it sounds like, until more or less the end of the year, and then who knows what happens. But Carney did make the comments that old trade agreements with the U.S. are done. A lot of the Canadian oil goes down into the U.S. And boy, oh boy, we just hear everything out of Trump. Some big tariffs, some no tariffs. It's a very confusing environment. How are the Canadian companies impacted in this new government in Canada, balanced out with Trump's wild nature?
Well, at this stage, I think that the politics of oil are different from the politics of the auto industry or aluminum or forest products. Those are going to be more challenging ones for the federal government in Canada. I think the energy industry has been lobbying the White House about the fact that the refiners in the Midwest and the refineries in the Gulf of America do not are not able to process oil outside of Canadian oil. And if you remove, lower production from Mexico of their heavies, and you cut off and sanction Venezuela, you remove those volumes, it just means the Canadian story is better and better for it. So I think, and they also use our natural gas during the winter time. So I think that there's, the energy side is one of the ones that is going to be less contentious, because even though Trump says, I don't need your oil and gas, I don't think he's been listening to his energy minister and his interior minister when they say that's the reverse. And drill, baby, drill, which he keeps on talking about for the states, and opening up land on federal lands onshore and offshore for more drilling. All of that takes time. Could the U.S. increase production by 2 million barrels a day by the end of the decade? Yes, but not in 2025 or 2026. So they will need our product in the meantime. So I'm more optimistic about the energy side. I think it's a political football. I think Mark Carney, may try to use that, as a lever to get some support for autos and forest products and mining and aluminum and steel. But the bottom line is the Americans are going to be pretty tough on those other areas, because they do have, issues there where our tariffs and non-tariff tariffs are an issue. But the oil side, I think, if it becomes a political football, then I think the concern that Western Canada has about the unfairness of a Carney government allowing energy to be used as a football and hurting Western Canada, that could cause significant alienation, and that would make things very difficult for the federal government.
Joseph, what about the LNG terminals that are not only being built but also planned for Canada? Does any of that change with this new administration?
No, I think it just reinforces that the BC government is going to be very in favor of getting them going. And also the Indigenous people will want them to go, because this way they have, economic freedom. They have more revenues. They have more jobs, more revenues for the provincial government. Everything goes, Rockies LNG, Cedars LNG, LNG Canada Phase 2 or Train 2. All of those, I think, go ahead. But it's the problem of getting new projects going, where the federal government's saying, oh, in the old days it was a 5-year approval process. Now it's a 2-year approval process. And yet, the industry says it should be a 6-month approval process. And that's what the Americans are doing down south. Trump has said, we want to approve deals in 6 months. If we can't do it in 6 months, then the regulators are the problem.
Are we actually going to see this happen, though, Joseph? So much of what I've heard is that governments can try to move forward with some of these permitting, but now there are so many different permits that need to happen that there is the potential that work that you should have done for this one permit that you don't need to do anymore simply gets passed on to another agency.
That's where I think the U.S. is doing the right thing. They're putting everything under one regulatory body that has to sign off on everything, and they're taking the power of the decision making away from the EPA or Interior or whatever. And Canada has to do the same thing. We have, just because the energy industry is such a, political football, but, if Quebec wants to put in a new hydro project, they don't have the same issues, with the lengthy approval process. If, you want to put a new cement plant in Quebec, a new aluminum plant, to me, Western Canada has been sacrificed on the altar of Ontario and Quebec because of the population there. And of course, that's where the Liberal power base is. And the reality is the unfairness of it, I think, is being realized by people in Canada. It's, the election was not a win for for the growth story of Canada. But the question is Carney going to keep his leftist tendencies, or is he going to realize that Canada's economy is going down the drain if the trade war with the U.S. continues, and it takes many years for him to find new markets for the Canadian products that are produced in Eastern Canada? So I think this is an East versus West battle. And I think right now, Carney's is going to have to decide, does he want to run with his political, his personal views on climate and his left-wing policies, or does he become the prime minister for all of Canada and do what's in the best interest of Canada? On his speech on a Monday night, he threw a few positive bones out, but he also threw a lot of shit out. And I think which Mark Carney do we get? We still need to wait to find out and see.
Yeah, it's a great point. We're going to have to see what actually gets implemented. There's always a lot of talk. Let's see what the action is. Another element of the energy space we should probably bring in that ties into that, Joseph, is the infrastructure. What about pipelines? Because when you think about something like Alberta, it's always shipped oil down into the U.S. because it's not by water. It's not by a port. It's in the middle of the country. So when you think about the pipeline infrastructure, are there opportunities there? Are there issues there logistically? How do you see the infrastructure element for shipping and piping all of these liquids and fluids?
Well, in terms of within Alberta and within Saskatchewan, that's provincial jurisdiction. When it becomes, intra-provincial, that's when the feds can get involved. So will there be more natural gas pipelines through BC to the coast, or more expansion of the pipelines that are there? I think that if it's within the control of the local provincial governments, yes. If it requires a major new pipeline that the feds can get involved, I don't think so. There's talk that the TMX could be expanded by another 300,000 barrels a day by the federal government at some enormous, gigantic cost, because like the cost overruns they had, they just didn't know what they're doing. And, right now, the commentary in the industry is because of the slowdown in drilling, it may take till 2027 before TMX is fully utilized. So that really, to me, is an issue, is we right now have sufficient capacity and we also have capacity going south. But to see a growth in the industry could, because of our significant natural resources, that is the question mark where the federal government can either support us or hinder us. And right now, my concern and what the concern of the industry is that there will be hindrance out of Ottawa.
Yeah, a lot of question marks around what's going to happen in the energy sector here, and just so many different factors at play. But some of the key ones also being, is a recession around the corner? And again, what are these governments going to do to either support or push down this sector? Right now, price is not looking great. But Joseph, if you're right, and we see a near-term low around that $55 level, maybe even a little bit higher, and we get a bounce, then these stocks, we all know how much they can come ripping back. But that recent breakdown in price, very interesting simply from a chart perspective. Again, this has been Josef Schachter, founder and editor of the Schachter Energy Report. It's great having you on the show, Joseph, every month. And everyone, thanks for tuning in to this weekend show. Be sure to go back through our website, podcast, YouTube channel, and Substack account to keep up to date with all our daily editorials, market commentary, and company updates. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.